So, like I said, I think so far we have been able to solve like three different illustrations. Let me even confirm that. I know. Um, Please, I will encourage you to practice the remaining questions that you have. Laura, are we still going to complete the cost of capital? I don't understand. What do you mean by that? Speak up, Laura.
Sorry, sir. Before we enter capital budgeting, we're supposed to look at project specific cost of capital and our cooker. So,
We've not done it.
no,
Uh,
nope.
okay. No worry. I will check. I will check. Are you sure we've not done project specific cost of capital? Anyway, I will check. I will check. No worries. Okay. All right. So we have solved this one. Then I shared a question with you, which we also solved. I don't know, but let's have this last one. This last illustration. This is the last question tested on capital budgeting, which relates to internal rate of return. I will need one of you to read the question for us. You start from the requirements. Quickly, within the next 1 hour, let's see how far we can go with this one. Who is helping us to read it? Yes. Who is helping us? Okay. Required. Calculate the expected internal rate of return associated with the manufacture of VC4. Show all workings to the nearest million. Then B1. What is meant by an asset beta and how is it different from an equity beta? B2. If you are told that the company's equity beta is 1.2, the market return is 15%, and the risk-free rate of return is 8%. Discuss whether you would recommend introducing the product. Number C, the company is worried that the government might increase corporate tax rates. Advise the directors by how much that the corporate tax would have to change before the project is not financially viable. A discount rate of 17% per year may be assumed for Part C. All right, so that means in this Part C, you have to calculate sensitivity margin of tax liability. You have to calculate sensitivity margins of tax liability. So I want to calculate internal rate of return. You then go back to the body of the question and read from A to Z. Now, when you look at this question, you will see that examiner has given you information about you are given direct costs, and direct costs are divided into labor, material. Material is subdivided into 4 different items. Then you are also given indirect costs. When you look at this question, mainly, this is more like relevant costing in performance management, which simply means that if you don't have deep knowledge of relevant costing, certainly you can't do well in this kind of a question. Therefore, what are you supposed to do to solve this question correctly? What are you supposed to do? To minimize error, the most important thing you need to do is to bring out all relevant variables that you need. In the requirements, you have to calculate internal rate of return. And you know that to calculate internal rate of return, you are going to carry out three steps. Step one is to assume two different discount rates that will produce a positive and negative NPV. Then step two, you calculate internal rate of return using internal rate of return formula. Then step three, you advise on the acceptability of the project. These are the three steps you are supposed to carry out to calculate internal rate of return. But when you look at this question, you have to be very careful before you put your pen to paper. You must understand what you are doing before you begin to solve. So, like I said, to minimize error or to ensure that you avoid making costly mistake. So the best thing is that you are going to bring out all relevant variables. You recall, we have a format for calculating NPV where you have multiple variables. In this question, you are given selling price, you are given variable cost, different kinds of variable cost. You have indirect cost. So you have other information in the question. There is taxation, there's also inflation. So to solve this question correctly, then it means that you have to bring out all relevant variable line by line before you begin to solve. All right. So as I'm reading, any information that I have that is relevant, I will go and do working for that. I need you to open to the material at your end because I may need to switch so that we can complete the question as quickly as possible. And then thereafter, we'll move to adjusted present value. Before we move to the adjusted present value, Laura was saying that we still have cost of capital outstanding, project specific, even though we have calculated project specific under the question on AK PLC and also the one we did last time, which is the Ferrari PLC. But that notwithstanding, my intention was that I've completed cost of capital. So, but again, like I said, I will check if truly I have not completed it. Then we have to talk about um, project specific and also Wakuka. All right. So Femi Appliances Limited is a Nigerian-based manufacturer of household appliances with many distribution centers across various locations in Nigeria and along the ECOWAS sub-region. FAL is now considering the the development of new motor vehicle vacuum cleaner, VC4. The product can be introduced quickly and has an expected life of 4 years. So useful life is 4 years. Okay. Change with a more efficient model. Costs associated with the product are estimated to be direct cost per unit. So we are given labor. Let me switch. So open to your material so that this will save our time. Let me switch to working notes so that as we are reading it, then we'll be solving. We don't need to read everything before we begin to solve. So I know for sure that, let me first of all put it solution. So illustration number 6. I think that's page 64, 40 something. Let me check. Page 49. Okay. So Femi Appliances is the name of the company. So, like I said, the first thing you are going to do is to carry out your workings on the variables that you need to do justice to the question. So in order not to be flipping from one page to another, let me start my working from here. Remember what I told you on the day of your exam. Your working should be the last thing you are going to do. Don't make working as in your first. You don't do working in your in the first page of your answer booklets. You need to estimate. For requirement one, you want to calculate internal rate of return. Looking at the questions, how many pages will contain the IRR that you want to calculate? Then number to solve requirement B and C, how many pages do you need? Then you now move to the next one, which should be the fourth page or the fifth page for your workings. so that you don't start with working. You have to start with the main solution. However, because of the limitation, this is uh, so that I don't need to be switching from one page to another. So let's first of all do the workings. So working number one, I want to determine sales. Remember, we have a format for calculating NPV. So when you have multiple variables, you are expected to use columnar format to calculate the net present value, positive present value, and the negative present value. So in this case, I need to determine sales. Sales is the first item in the format, followed by variable cost, followed by incremental fixed cost, and any other relevant cash flows. So I want to determine sales. I will then go to the question, how much is the sales selling price? So I will go to the question and look at where I have information about selling price. All right. So when you go to the second to the last paragraph of the question, when you go to second to the last paragraph of the question, that's where you have information about selling price. So you are told that the price per unit of the product in the first year will be 11,000 naira. So 11,000 naira is the first year's
Service.
price. That means the 11,000
Is
naira
that battery
is
or
a
the
real
light?
cash flow.
Sorry, for battery in the space is super. I can
It means that the 11,000 naira is a real cash flow. So then I need to check from the question in case I'm given
see
inflation rate
is
for
your
the
way
selling
of what
price.
happening. Then will be the end of our marriage. Thank you for
King,
very nice.
if you try that next time, I will remove you from this class. You disrupted me, I muted you, then you are muted yourself. If you try it next time, I will remove you. You are distracting my class. Yes. You are told that the price per unit of the product in the first year will be 11,000 naira. So examiner has given us the selling price is in first year's price. So that means this 11,000 naira is a real cash flow. So I will then go back to the question and check if I'm given inflation rate on selling price. So examiner told you that inflation rate is expected to be 5% per year and prices will be increased in line with the inflation. So inflation rate on selling price is 5%. Therefore, I need to go and inflate the 11,000 naira given to us. Because selling price is in first year's price, that means that inflation should start from year two. So I will then come here, selling price at inflation rate of 5%. The useful life of this project is 4 years. So I will do for year one, year two, year three, and then year four. The first year price is 11,000 naira. So we want to grow this 11,000 naira by 5%. I will then carry my calculator. 1.05 multiplied by 11,000 equal to 11,550.
11,550.
11,550 multiplied by 1.05.
12.
That's 12,128. What you have in the calculator multiplied by 1.05. 05.
12,734.
12,734. So with this, we have inflated the selling price. You can see the year one price still remain the same as 11. All right. All I need to do is to now multiply this with number of units. So I will then go back to the same paragraph where you have the selling price. That's where you also have the units. You are told that demand is projected at 12,000 units, 17,500 units, 18,000 units, and then 18,500 units. So units demanded 12,000, 17,500, 18,000 units, then 18,500. You then multiply. I will go back to the question and check in case examiner wants me to round my number. All right. So examiner has told us to calculate the expected internal rate of return associated with manufacture of VC4. Show all workings to the nearest million. That means examiner wants everybody to have the same result. That's why they want you to have uniform results. That's why examiner is specific that you should round your number to millions. Therefore, sales in millions will then be equal to, I'll bring out my calculator, 11,000 naira multiplied by 12,000 units equal, that's 132 million. Next one, 11,550, 11,550 multiplied by 17,500 equal 202 million.
2.125. Oh, okay.
202 million. Then year three. Year three is 12,128 multiplied by 18,000.
218.
That's 218 million. Next one, 12,734. 734
Yes.
multiplied by 18,500. That
236.
is 236. 236 million. So this represents our sales. I will then go back to the question. After sales, remember from our format, the first item is sales value. After sales value, we have variable cost. In this question, you are given multiple variable costs. Variable cost is not given to you directly, but you are given examples of variable cost. Variable cost is the same thing as direct cost. All right. So under the direct cost in the question, we have labor. So we need to go and do working for labor. Examiner did not give us first year price for labor. So we need to estimate that by ourselves. So working number 2. We want to calculate direct labor. So how do we do this? We then go to the question. According to the question, we are told that 3.5 scale labor hours at 500 naira per unit. So there are two types of labor in this question. We have skilled labor. For skilled labor, we are given 3.5 hours multiplied by 500 naira per hour. So what do we have here? We also have unskilled labor. Unskilled labor is, according to the question, 4 unskilled labor hours at 300 naira per hour. So 4 hours multiplied by 300. This will give us 1,200. Then 3.5.
1,750.
1,750. When you add it up, that will give us 2,950. So this 2,950 is the first year price for labor cost. That's the first year price for labor cost. So I will then calculate total labor cost. So total labor cost for year 1, year 2, year 3, and then year 4. So labor costs, I will go to the question. What's the inflation rate for labor costs? According to the question, in the same paragraph where you have the selling price, examiner has told us that wage and salary costs are expected to increase by 7% per year, and all other costs, including rents, by 5% per year. So what that means is that all the variables you are given in this question will increase by 5%,
7%.
except labor cost, which will increase by 7%. Therefore, the first year price is 2,950. So we then increase this by 7%. So you carry out your calculator, 1.07 multiplied by 2,950 equal to 3,157. Here is 3,157. What you have in the calculator multiplied by 1.07. That is 3,377.
Yes.
What you have in the calculator multiplied by 1.07.
3614.
3614. Okay, then you multiply with number of units. So you then say units. The first year unit is 12,000, 17,500, 18,500, 18,000.
No, I
So
think year 3 is 18,000. Sorry. Abi?
oh, okay.
Yes, yes.
Let me, yeah, you are correct. Year 3 is 18, year 4 is 18,500, year 3 is 18,000. Okay, I tested you. I want to be sure you are I want to be sure you are following. That's a number. Yeah, now let's multiply to get the total direct labor cost.
35 below 400,000. So should we do
35
35.4?
million. That's 35. Examiner says you should round it. So 35. Let me do here 43614 multiplied by 18,500. So what do we have? Here is 67. Year 2 will be equal
Yeah,
to
55248.
round your number. Give me
That is 55.
55. Year 3. Year 3.
Yeah, 3 is 60.
Year 3 is 60. So we have calculated labor cost. So I will then move to working number 3. According to the question, after labor, we're also given material. So under material, we have 4 line items. The first one is 6 kilos of material Z. So we have material Z, material P, material Q, and then other variable costs. So let's go and determine material costs. So working number 3, material Z. So according to the question, for material Z, you are told 6 kilos of material Z at 146 naira per kilo. So there's difference between kilo and units. All right. So since material Z is in kilo, we need to convert the units to kilo by multiplying the units for each year with 6 kilos. So that will give us total kilos for material Z. But first thing first, we need to inflate the prices. Therefore, I will then do, this is for year 1, year 2, year 3, then year 4. The material cost at 5%. The first year price is 146. So this 146 will increase by 5% per annum. Therefore, I will then bring out my calculator. 1.05 multiplied by 146 equal, that's 153. What you have in the calculator multiplied by 1.05, that is 161. What you have in the calculator multiplied by 1.05, that's 169. So we have inflated the material Z. The next thing is to multiply this material cost with kilos. So how many kilos are needed for each year? So I can say kilo needed. So let's go and do workings for the kilo needed. Kilo needed. Like I said, there is different kilo and unit are not the same thing. Material Z is based on kilo, and you are given 6 kilos per unit. In this case, you are going to multiply the number of units with the kilos. So first thing first, for year 1, the unit for year 1 is 12,000, followed by 17,500, 18,500, sorry, 18,000, then 18,500. Okay? Now, you are given 6 kilo per unit, 6 kilos. So, I would then say multiply by 6. All right. 12,000 multiplied by 6.
72.
72,000. 17,500 multiplied by 6.
105.
105,000 kilos.
108.
18,000 multiplied by 6.
108. 108.
108,000. Then year 6.
111.
So year 4. 1,100,000 kilos. So these are the total kilos needed. However, if you go back to the question, the examiner has told us that there's kilo of 70,000 in the inventory. In the same paragraph where you have the selling price. No, before the paragraph before the selling price, you are told in the question that 70,000 kilos of material Z are already in the inventory and are not required for other production. The realizable value of the material is 9.9 million naira. So the company has 70,000 kilograms of material Z in the inventory. That means they have it in stock. So if they have it in stock, the company is not going to pay the original price of the material in stock are irrelevant because they are sunk costs. However, since you are going to need 6 kilos of material Z for the production of VC4, in that case, the 70,000 that you have in the stock, you are going to use it for this project. Therefore, I would then come here. Since you already have it, you are not buying. So I would then say inventory 70,000. So you need 72,000 in the first year. Out of the 72, you already have 70,000. Therefore, how many kilos do you then need in year 1? That means only 2,000 kilos of material Z will be bought in year 1. In year 2, we are going to buy 105,000. Year 3, 108,000. Then in year 4, 111,000. So these are the amount of kilos These are the kilos needed. Okay. So now that you have the kilos needed, you need to go and multiply with the units, with the material cost per unit. So 2,000 in the first year, followed by 105, 108, then 111,000. When you multiply, 146 multiplied by 2,000 multiplied by 2,000, that is
292.
292,000. Remember, our figures are in million. So I would then say total in millions. 292,000 is the same thing as 0.3 because our figures are in million. Then 153, 153 multiplied by 105,000 equal to 16 million. Next one, 161 multiplied by 108,000 equal to 17 million. The next one, 169 multiplied by 111,000.
19.
That's 19 rounding. All right. So in that same paragraph, you are told that the realizable value of the material is 9.9 million. The 70,000 kilogram of material Z, if the company wants to sell it, they are going to earn 9.9 million naira. But the company will not be able to sell it because they are going to use the material Z. They are going to use that 70,000 kilogram for production, so they can't sell it. Therefore, this 9.9 million naira will then represent opportunity cost. That is the benefit forgone as a result of using the 70,000 kilogram of material Z for this project. So if I like, I can come here, opportunity. Okay, let me see. What's wrong with you? All right. So the realizable value of the 9.9 million naira represents opportunity cost. So if I like, I can then come here to say opportunity cost. What's wrong with you? You don't want me to connect? Opportunity. What's wrong with you? Be careful. Let me see. I don't know. The pen is not writing. Okay. Opportunity cost. So this will be 9.9. So you then add up. If you like, you can make it a separate line item when you are calculating your NPV. But the issue with that is that there's tendency for you to forget dates. All right. So Now that you remember, just put it together. 0.3 plus 9.9 will give us 10.3 or 10.2 rather. Then you can just round it. Examiner says you should round your number to million. So that will give us 10 million. So here is 16, 17, then 19. So this represents the total cost of the material, which you are going to, this is the grand total, which you are going to need when you are calculating your NPV. I will then go next one, number 4. After material Z, we also have component P. All right, we have component P. We are given 3 units of component P at 480 naira per unit. So I will come here component P. We are given 3 units multiplied by 480 naira per unit. So this will give us, what do we have there? 3 multiplied by 480, 1,440. So component P, the first year price of component P is 1,480. So you then calculate for year 1, year 2, 3, and then year 4. So the components at inflation rate of 5%. First year price is 1,440. So 1.05 multiplied by 1,440 equal 1512. 1512 multiplied by 1.05, 1588. What you have in the calculator, multiply by 1.05 equal 1667. You then multiply with units. 12,000 units, 17,500, 18,000, 18,500. We multiply 1440 multiplied by 12,000 units equal to 17 million. Year 2,
26. 26.
26. Year 3,
28.5.
that's 29.
Okay.
Year 4,
31.
31. So we're done with component P. Then move to the next one, which is component Q. Component Q, we are given 1 unit of component Q at 640 naira. Working number 5. Component Q, which is 1 unit multiplied by 6, is it 640? Let me confirm.
Yes, please.
Yes, 640. Which will give us 640 naira per unit. So we do for year 1, 2, 3, and 4. So components Q at inflation rate of 5%. First year price is 640. 640 multiplied by 1.05
672.
That is 672. What you have in the calculator multiplied by 1.05.
705.6. So 706.
705. That's 706. Next.
741.
741. So unit is 12,000. 17,500. 18,000. 18,500. Then multiply to get the total cost.
Mm.
640.
Okay. 7.68. So you do 8.
7.7. That's 8. Next one. 672 multiply by 17,500.
12.
That is 12. 706 multiply
13.
by 18,000.
13.
That's 13.
14.
14. So we are done with that. Then number 6. Working number 6. After component Q, we also have other variable costs, which is 210 naira per unit. Other variable cost, OVC, is given as 210 naira. All right. So I will do for year 1, year 2, 3, and then 4. Other variable costs at 5% per annum. The first year price is 210 per unit. 210. 1.05 multiplied by 210. 0.05 multiplied by 210. 221. What you have in the calculator multiply by 1.05.
232.
232. What you have in the
243.
calculator multiply by 1.05. 243. You then multiply with units. 12,000. 17,500. 18,000. 18,500 units. We multiply to get the total cost of other variable costs. 210, 210
3
multiplied by
million.
12,000.
Mm.
That's 3. 221 multiplied by 17,500.
4.
That is 4. Okay.
Which one is 4?
4. Then year 4. 243 multiplied by 18,500.
Still 4.
Okay. Which is 243 multiplied by 18,500. That is 4. So we are done with that. Working number 7. I will then go back to the question. What do you have? We are done with direct costs. We then move to indirect costs. Under the indirect cost, we are given apportionment of management salary 10.5 million naira per year. Anything apportionment is irrelevant cost. It's not related to the projects. When you talk about apportionment, a company will incur overhead, and the overhead will be distributed across. So the overhead distributed is on the basis of apportionment. It could be on the basis of floor space, number of employees in each of the departments. It could be based on labor hours. It could be based on anything. However, so in relation to relevant costing, anything apportionment is irrelevant cost. Therefore, the 10,500,000 naira per year is irrelevant. Next item, under the indirect cost, we have tax allowable depreciation of machinery, which is 21 million naira per year. That is called capital allowance. That is capital allowance. So we are going to need that information later on. Next item is selling expenses, not including any salary, 16.6 million naira per year. Selling expenses, whether variable or fixed selling expenses, is relevant, all right? Because if you don't incur selling expenses, you will not be able to make sales. That's why selling expenses, variable or fixed, are relevant. So we need to go and do calculation for selling expenses. So number 7, selling expenses. We are given 16.6 million per year. So we need to do working for this. We inflate with 5%. So we do for year 1, 2, 3, and then year 4. So selling expenses at inflation rate of 5%. Look up and pay attention. The first year price is 16.6 million. So when you round that up, that will give us 17 million in year 1. However, if you want to inflate at 5% for year 2, you are not going to put 17 million, you are going to put 16.6. So you then say 16.6 multiplied by 1.05. That is 17.
17.
So what you have in your calculator, multiply by 1.05.
18.
That's 18.
And
Again,
19.
what? And then 19. That's all you need to do. So this is what we are going to post. That's what we are going to post. Working number 8. We'll go back to the question. After selling price, you are given apportionment of head office cost 5 million naira per year. Again, this is an apportionment. Head office cost is not relevant. You ignore it. Okay? Rental of building 10 million naira per year. Except if the company rents the building because of this project. Other than that, that will not be, that is irrelevant. Rental of building of 10 million naira is not relevant because it's a fixed cost. Okay? Whether the company undertake this project or not, the rental cost will surely be incurred. Except if you are told that the company will rent the building because of this project, but the company did not say otherwise. Therefore, we ignore it. Next item, annual interest charges, 10.4 million. That is not relevant too. You remember when I was giving you the note under relevant cash flow, I said interest, the absolute amount of interest is irrelevant because the cost of capital to be used to evaluate the project already included interest. Therefore, if you now take the absolute amount of interest, that will mean that you are double dipping. And that's why anytime you are given interest expense, you just have to ignore it. Under capital budgeting, you ignore. It is irrelevant. Next item, you are given other annual overheads, 7 million naira. There is difference between, in this case, examiner say other annual overheads. There are two types of overhead. We have variable overhead and then fixed overhead. Only variable overhead is relevant. Fixed overhead is irrelevant. However, in this question, examiner told you that other annual overhead, 7 million, including apportionment of building rates of 2 million, which means that out of the 7 million naira, you have to remove the one that has to do with apportionment, which is 2 million. The difference that you have is relevant. So in this case, I would then say other annual overhead, 7 million, other annual overhead, which is equal to 7 million minus 2 million. This will give us 5 million naira per annum. Okay, so that's what we are going to work on. So for year 1, 2, 3, and then year 4. So other annual overhead. Let me rewrite it. At inflation of 5%, the first year is 5 million. Therefore, 1.05 multiplied by 5 million. That's 5.255. What you have in the calculator, 5.25 multiplied by 1.05.
6.
6. What you have in the calculator,
6.
multiplied by, that is 6, right?
Yes, sir.
Okay, so that's 6. So that's what we are going to post. You can see this is a long question. If you don't make this adjustment, if you don't carry out this kind of workings, that's likely for you to give what belongs to Peter to Paul. So if you do it this way, it will give you clarity. And once you are done with all your relevant workings, posting will be very easier and then faster. Next item. So we are done with indirect cost. The next paragraph, you are told that if the new product is introduced, it will be manufactured in an existing factory and will have no effect on rate payable. The factory could be rented for 12 million naira per year, not including rate, to another company if the product is not introduced. So this factory space can be rented for 12 million naira to another company. Of course, you cannot rent it out because you are going to use the space for this project. So because your examiner has told you that if the new product is introduced, it will be manufactured in an existing factory. So that existing factory can be rented to another company to earn income, but the company will not be able to earn the 12 million naira. All right, the company will not be able to earn the 12 million naira because you are going to use the space for this project. So that 12 million naira will then represent opportunity cost. So I would then say rent. Opportunity cost. So this is 12 million per annum. Okay, so for year 1, 2, 3, and then year 4. So it's not compulsory that you have to do working for some of these things. If you know what you are doing, but if you write it down, it will make it clearer. All right, so that you don't miss any one of them. So we then come here, opportunity costs on rent. At 5%. The year one price is 12 million. 12 million multiplied by 1.05.
13.
That's 13. What you have in your calculator, multiply by 1.05.
Still 13.
13.
And
What you
14.
have in the calculator, and then 14. That's it. That's it. We are getting there gradually. So, yes, Laura, talk to me.
Sorry, sir. Please, what's the indication that the rent of 12 million is supposed to be inflated? Because the question says it could be rented for 12 million per year. So why are we inflating it?
If you go back to where you have information on inflation, where you have the selling price, examiner has told you that wages and salary costs are expected to increase by 7% per year, and all other costs, including rents, by 5% per year. Is it clear now?
Yes, sir. Thank you.
All right. Yes, Sharafa, what's your question? Sharafa Dean, talk to me. What's your question? You raise hand. Okay. So, move to the next paragraph. In the next paragraph, you are told that new machinery costing 86 million naira will be required. That's the initial outlay. Initial outlay is 86 million naira. The machinery is to be depreciated on a straight line basis over 4 years. Okay, and has an expected salvage value of 2 million naira after 4 years. The machinery will be financed by a 4-year fixed rate bank loan at an annual interest rate of 12%. Additional working capital requirement may be ignored. So, the cost of the project is 86 million. You are told that scrap value will be 12 million after year 4, and this will be depreciated for the next 4 years. Therefore, 86 minus 2 million, that will give us 84 million. 84 million divided by 4 years will give us 21 million naira. That is how they arrive at the tax allowable depreciation of machinery of 21 million per year, given in the question. So, working number 10, we want to calculate tax saved on capital allowance. Okay, because this is on a straight line basis, we don't need to be sweating over this. First thing first, you calculate your capital allowance, which has been given to you as 21 million naira. But in case you want to calculate it yourself, capital allowance is the cost of the project minus scrap value divided by the useful life. So the cost of this project is 86 million. Salvage value is 2 million divided by 4 years. So this will give us 84 divided by 4 will give us 21 million naira per year. That's annual capital allowance. So to now get the tax saved on capital allowance, tax saved is capital allowance multiplied by company tax rates. So capital allowance is 21 million. I will go back to the question, what is the company tax rate? According to the question, you are told that the company tax rate Income tax is at the rate of 35% in the last paragraph there in the question. Income tax is at the rate of 35% payable in the year profits occurs. So payable in the current year. So 35%. I would then say 21 million multiplied by 35%. This will give us annual tax saved of 21 multiplied by 0.35 equal to 7.3 million. This is 7.35 million. Since our number is rounded to million, so this will be 7 million per annum. Approximately 7 million per annum. Okay. So every year we are going to claim, the company will claim 7 million. All right. So that's that. Next item, we'll move back to the question. After that paragraph, the next one is the paragraph where you are told that the new product will require 2 additional managers to be recruited at an annual gross cost of 2.5 million naira each, and 1 manager currently costing 2 million naira will be moved from another factory where it will be replaced by a deputy manager at a cost of 1,700,000 per annum. Okay, so how do we treat that information? So let's go and do working for additional labor costs. That will be working number 11. Additional labor costs. So you are told that 2 managers will be needed. 2 additional managers will be needed. So 2 multiplied by 2.5 million. This will give us 5 million naira. Then we're also told that 1 deputy manager so this will at a cost of 1.7 million. The assistant manager that is on salary of 2 million is irrelevant, because whether the company execute this project or not, you have to pay that 2 million. So where the manager is currently working, there will be vacuum. Since you want to transfer the manager on 2 million naira, you want to move it to another factory. So you need to employ a deputy manager. So the cost of that replacement cost of 1.7 is the only relevant cost. The existing cost of 2 million naira is irrelevant. Okay, so I will then add it up. This will give us 6.7 million per annum. That's the total additional labor cost. So we then inflate this for year 1, year 2, year 3, and then year 4. Additional labor cost at 7%. Remember, labor cost is at 7%. Every other cost is at 5%. So the first year price, remember, our labor cost per year is 6.7 million. So when you round it up, that will be 7 million in the first year. However, when you want to inflate from your calculator, you have to type 6.7. So 6.7 multiplied by 1.07. That's 7. What you have in your calculator, which is 7.169 multiplied by 1.07. That's 8. What you have in the calculator multiplied by 1.07.
You see 8.
That's 8.2 rounded to 8. So that's that. So now that we are done with all the relevant workings, we can then proceed to calculate our internal rate of return. All what we have been doing, now we have one more line item, which is the third paragraph before the last paragraph. We are told that FAL will use the 16 advertising campaigns for its distribution centers to also advertise the new product. This will save approximately 5 million per year in advertising expenses. So since the company is not incurring additional advertising costs, therefore the 5 million naira is irrelevant. We ignore it. Okay, so that's end of the question. At this point, we can then proceed to calculate the internal rate of return. All what we have done so far are not what the examiner asks you to do. We are just calculating workings. These are workings, all right? This is not the main solution. If you stop here and the examiner say pens up, you can except if the examiner is kind enough, or just want to show you mercy. That's why they are going to give you something in this your workings, because this is not what the examiner asks you to do, right? And that's why when you are solving this kind of a question, don't wait until you finish your working before you begin to solve the main requirement. So as you are done with one working, go and post. Then you continue like that, because there's likelihood that you may not have time to complete it, and then examiner will not just give you for workings, because working is not what you are asked to do. Okay, so I will then come here. Requirement number A. Let me give a space. Calculating. Now we want to calculate internal rate of return. When you look at all our workings, all the cash flows that we have identified in the question, you will see that they are massive. They are too much. So in this case, the best approach would be for you to determine relevant cash flow first, because with relevant cash flow, you can use any technique to evaluate the project. So first thing first, you need to calculate relevant cash flow before you then calculate your internal rate of return. So I can say calculating net cash flow. Calculating net cash flow. Okay. So for year 0, year 1, 2, 3, 4. Then you create additional column for workings. So we are starting with the sales. We have calculated sales value for respective years. That's where we started from. So 132,202. 132,202. Yes. Give me for year 3 and 4.
218 and
Uh-huh.
236.
236. So this is working number 1. After this, we also have labor costs. Labor costs in year 1, we calculated 35, 35, 55, 60, 67.
67.
Here is 35,
55,
55,
60,
60, and then
67.
67. That's working number 2. Then we also have material Z. For material Z in year 1, we calculated 10, 16, 17, 19. 10, 16, 17, 19. Here is 10, 16, 17,
17,
and then
19.
19. Working number 3. Next one. After material Z, we have material P.
Component P.
Sorry,
Yeah.
component P. 17, 22,
26,
26, 29, 31.
31.
Component P. Component P. What was the first one? I
17,
think 17,
26,
26,
29, 31.
29, and 31. Working 4. Then we also have component Q.
8,
8,
12,
uh-huh,
13, and 14.
and then 14. That's working 5. We have other variable
Other
costs.
variable.
Other variable
3,
costs in year 1. 3,
3, 4, 4, 4.
4,
4,
and then
4,
4. Working
4.
number 6. After other variable costs, I think we have selling
Selling
expenses.
expenses.
Okay.
17,
Selling expenses.
18,
17,
17,
17,
18, 19.
18, and then 19. That's working 7. Then after that,
Other
after selling
annual
expenses, we have other annual overhead,
overheads.
5566. Other annual overhead, which
5,
is
5,
5, 5,
6,
6, 6. Working 8. Then after this, we also
Rent,
have rent,
rent,
opportunity costs. Rent, opportunity cost. In the first year is 12. The next one, I think, is
13,
12 or 13,
no,
okay?
13, 13, 14.
13 and then 14. That's working number 9.
Tax saved.
So that will come later. We have additional labor costs.
Oh, yeah.
Additional labor cost in the first year is 7 million.
7, 7, 8, 8.
8, 8. That's working 11.
11.
Then, so we then add it up. 6 minus other relevant costs.
Okay.
This will give us profits. So 132
18. Someone should
in the
please check. 18.
first year is 18. Let me do for year 4 to make it faster. 236 minus 67 minus
The other
19. Hold
47.
on.
Okay.
Minus 31 plus 14, that's 45. Minus 45. Minus 23, 29. Minus 22 equal to 54. I hope this is correct. Is it 54? Oh yeah. Tosin, which one?
47, the second one.
47.
The third one, 50.
Okay. 50. So I believe the one I did for 54 is correct. So now that we have the profits, the next thing is to then pay tax. I would then say tax at company tax rate of 35%. According to the question, the examiner told us that tax is paid in the year profit is earned. Therefore, 18 multiplied by 0.35, that's 6. Next, 47 multiplied by 0.35, that's 16.
16.4. Yeah.
Then
The
50 multiplied by 0.35,
18.
that's 18.
And the last one,
The last
last
one,
one, 19.
19.
19. So the next thing will then be tax saved on capital allowance. You claim tax saved on the capital allowance. We have calculated tax saved on capital allowance. That's working number 10 to be 7 million naira per annum. Okay. So this will reduce the tax liability. 7 million, 7 million. That's working number 10. After tax saved, you have scrap value. Examiner call it salvage value. Which is 2 million naira per annum. Sorry, for the last year. Then we are going to have initial outlay. Initial outlay is 86 million. So there is no working capital in the question. Therefore, we then calculate net cash flow. Here will be 86. This is the net cash flow. All right. Let me do for year 4. 54 minus 19 plus 9. That's 44.
The first
Yes.
one, 19.
19.
38.
38. And this should be 39.
39.
All right. So with this net cash flow, you can use any technique to evaluate the project. You can use NPV. You can use internal rate of return. You can use payback period. You can use modified internal rate of return. You can use project duration. The only technique you cannot use is accounting rate of return because accounting rate of return makes use of accounting profit or loss. So now that we have the cash flow or the net cash flow, we can then calculate the internal rate of return. So I'll then say calculating internal rate of return. And you know that to calculate internal rate of return, you are supposed to assume two discount rates that will produce two opposing NPV, a positive and negative NPV. So what am I supposed to do? So I can then come here, assume. Now, when you want to assume your discount rate, you need to compare the size of your cash inflow and the size of the cash outflow. Cash outflow is 86 million. Cash inflow, 44 plus 39 plus 38 plus 19. When you add the four of them together, it should be around 130 something or 140 something million, which is almost double the cash outflow. So in this case, if you
140.
assume 5%, you still be positive. If you assume 10%, it will be positive. Let's try 15% and see if it will be negative. Let's try 15% because the cash inflow is bigger, it's much more bigger than the cash outflow. So let's start with 15% and see what we're going to get. So we use this 15% to calculate NPV. So create a column for year, cash flow, discount factor at 15%, then present value. So year 0, 1, 2, 3, and then 4. All right. So cash flow in year 0 is 86 million. 19 in year 1, 38 in year 2, 39 in year 3, then 44 in year 4. So somebody should give me discount factor for year 1 for year 1. Here will be 1.00. Year 1 at 15%. That should be 0.870.
6,
For year 2,
0.756.
756.
658.
756. 658. Then year 4.
572.
5 what?
72.
72. We then multiply to get the present value. All right. Let me complete my table first. Okay. Divide this one to 2. That will give me the NPV. So here will be 86. Then 19 multiplied by 0.87. Multiplied by 0.87. That's 17 rounding. Next one. 38 multiplied by 0.756. That's 29.
Yes.
39 multiplied by 0.658.
26.
26. 44
25.
multiplied by 0.5. That's 25.
5.
So final answer. 25 plus 26, that's 51. 51 plus 29, that's 80. 80 plus 19, that's 97. 97 minus 86, that's
11.
11. So we assume
Negative.
15%. We got a positive NPV of 11. then we need to assume a higher discount rate. So let's increase this to 20%. So 19, we need to calculate discount factor for year one at 20%. 1.2 raised to power 1 minus, that's 0.833.
833.
Then
0.694.
694.
0.579.
579.
0.482.
So we then multiply. So 19 multiplied by 44 multiplied by 0.48, so that's 21. Next one, 39
The
multiplied
first,
by 579,
the first one,
that's
16.
23. 16.
Yes.
Then the second year,
26.
26. So 16 plus 26, that's 42. 42 plus 23, that's 65 plus 21, that's 86. 86 minus 86 will give us 0. So that means we have found what we are looking for. All right. So our NPV, we assume 20% and 20% produce 0 NPV. Then that's our internal rate of return, because we said that internal rate of return is the rate that equates the NPV of the expected future cash flows to 0. So any rate that you assume and produce 0 NPV, that rate is the internal rate of return. So there is no need for you to use the formula for IRR again. You have seen what you are looking for. So I would then say, since internal rate of return is the rate that equates NPV of expected future cash flows to 0. Therefore, the internal rate of return of VC4 is 20%. All right. Okay. So that's it. However, you cannot earn your full mark if this is where you stop. Remember, this first requirement is 16 marks. Okay, requirements,
19.
sorry, it's 19 marks. So you can never earn the entire 19 marks if you don't state your assumptions. There are some figures in the question whereby you ignore them. Why did you ignore? So you have to state your assumptions. So let's quickly do that. So I would then say assumptions. Whether examiner asks you or not, it's a must that you state your assumptions. The calculation above is based on the following underlying assumptions. The first one, number one, I've told you, under capital budgeting, anytime you want to state your assumption, you must talk about cash flow. It's a given. What's the assumption on this? You then say it is assumed that all the cash flow estimates are realistic and will occur at the end of each year. If you want to go further, you can say that all cash flows have been inflated at the appropriate inflation rates. Then number two, you can talk about inflation. We're not given cost of capital in the question, so no need to comment on cost of capital. But we are given inflation, so you talk about inflation. What's the assumption on inflation rates? You then say it is assumed that the inflation rates, we are given inflation rate of 5% and 7%. So it is assumed that the inflation rate will remain constant within the period under consideration. Okay, so that's our assumption on inflation. Number three, any other assumption that you have made in the calculation, you talk about them. So we then go back to the question, starting from direct costs. Under the direct costs, no much assumption. We didn't make any assumption on that. We move to indirect costs. Under the indirect costs, we have apportionment of management salary. So you can comment on management salary. Management salaries. So you can then say the management salaries of, is that 10 million? Let me check. Of 10.5 million naira. Of 10,500,000 per year is an apportionment therefore not relevant to the calculation. So anything apportionment is irrelevant. Ignore it. Then number four, we also have apportionment of head office costs. So you can talk about head office costs. Head office costs. This is an apportionment and not relevant to the calculation. Okay. Next, number 5. After head office, we also have rental of building. Renter of building. This will be incurred irrespective of the decision taken on project VC4. Therefore, not relevant to the calculation. Number 6, we have annual interest. Okay. This is an irrelevant cost and therefore ignored in the calculation. Okay. If you want to go further, you can then say this is because the cost of capital to be used to evaluate the projects already included interest, but no need to be talking about, just ignore, move on. Number 7, after interest, what else? So I think that's it. Then you can talk about advertising expenses. We also have advertising campaign. So you can say since additional advertising expenses will not be incurred as a direct consequence of undertaking projects VC4. Project VC4 the advertising cost of 5 million naira is not relevant. Okay, so this is it. This is okay. If you mention like 5 different factors, assumptions, we are good to go. All right. This is not the end of the question. So before we move to the B part of the question, let me hear from you. Why did we, Sharafa is saying, why did we conclude that other annual overhead of 5 million, that is a variable overhead and thus relevant? Examiner has given in the question, Sharafa, hope you are listening. Examiner has told you in the question that other annual overhead is 7 million. including apportionment of building rates, 2 million. So the building rates, if that building rate is not given to you, you are going to ignore that information. If the building rate of 2 million naira is not there, if the examiner did not mention that 7 million naira, you are going to ignore it, because if you are just told other annual overhead, what kind of overhead? Is it variable overhead or fixed overhead? So since it is not splitted, then it will be a general overhead. But in the question, examiner mentioned that other annual overhead 7 million. This 7 million include apportionment of building rates of 2 million. That means out of the 7 million, the one that is not relevant is 2 million. You deduct it, then the balance is what is relevant that you are going to use. So that's the way we treated it, and that's what examiner expected of you. So Akko is saying that, please sir, can you still show that part of the skilled and unskilled labor treatment again? What do you want me to show there? Okay, you mean in our own solution? Speak up. Akko.
Sir, in the solution, I want to see whether you add the two together. I don't know how you.
Yes, that's how we did it. We added it together. We calculated skilled labor separate, unskilled labor separate. We then add the two. That's what make up the labor cost. This is it here. Are you seeing it? Akko. Akko, can you hear me?
Yes, I can hear you. Thank you. I've seen it.
All right then. So, finally on this question, in the B part of the question, examiner is asking you what is meant by an asset beta and how is it different from equity beta? 2 marks. Examiner just wants you to explain asset beta and then equity beta. You will recall when we did, okay, one of you said I've not done project specific. It's still surprising. It's still surprising to me. Well, we checked. So asset beta represents, asset beta is also known as equity, sorry, it's also known as ungeared beta. It measures only business risk. Then, whereas the equity beta measures both business and financial risk, and it is always higher than the asset beta. So that's what the examiner wants you to explain in that number B, 2 marks. You pocket it. I will show you. Then number B2, if you are told that the company's equity beta is 1.2, the market return is 15%, and the risk-free rate of return is 8%. Discuss whether you will recommend introducing the product. What are you supposed to do here? Examiner has given you information about capping. All right, you are given information to calculate capital asset pricing model, that is cost of equity. So first thing first, you need to calculate the cost of equity using capping. Then you then comment on the relevance of capping in project appraiser. So you comment on that. The number C part of the question, the company is worried that the government might increase corporate tax rates. Advise the directors by how much that the tax rate would have to change before the project is not financially viable. A discount rate of 17% per year may be assumed for part C. So in this part C, examiner wants you to calculate how much that the tax rate would have to change. That is, you have to calculate sensitivity margin of tax liability. So in this case, what are you supposed to do? Very simple. You have already calculated NPV. So in your net cash flow, you have tax liability. You calculated tax liability for the first year. Let me go back to your tax liability. We have where we have the net cash flow. Yes, this is the tax liability here. You have calculated the tax rate given to you is 35%. So examiner is now asking you, what is the percentage change? How much can the tax rates of 35% increase before the project will become unviable? That is, you are supposed to calculate the sensitivity margin of tax liability. So to do this, you are going to bring out the tax liability you have for each year. You then discount it using 17% to get the present value of tax liability. Then you use that 17% to calculate NPV. Okay, using your net cash flow. You discount this net cash flow with 17% discount rate given to you to get the NPV. Therefore, the sensitivity margin of the tax liability will then be equal to the NPV you are going to get over the present value of the tax liability. So it will give you the percentage change in the tax liability to make the project become unviable. All right, so let me stop sharing this. To make it faster, let me just open my golden book. Let me show you that quickly within the next 2 minutes. Oh, where are you, golden book? Where did I? 1 minute. I'm searching for it. Golden book. What's the name of the company? I think it's Bulala. Okay. Let me share my screen with you. Okay. Share. So please, I will advise you to practice as many questions as possible because you don't know where examiner will come out to you. Which question is that? I think is what's the name of the company again? You don't know where examiner will come out to you, and that's why it's important when you are going for uh, this ICAN exam, you have to be all out. You have to be well exposed so that wherever the examiner is coming to you, we'll be able to do justice to the question. So I want to encourage you, go and practice as many questions as possible, especially under capital budgeting. The last time ICAN tested capital budgeting was 2021, which is the question we are currently solving. All right. Ever since then, we've been waiting for ICAN to test capital budgeting question as compulsory. In 2017, the question we solved last week, which is Ferrari, was the questions tested in November 2017, 30 marks. In November 2018, compulsory question was cost of capital. In November 2019, compulsory question was adjusted present value. In November 2020, compulsory question was option pricing in capital investments. All right. Then in November 2021, it was internal rate of return. That was the last time ICAN tested capital budgeting question. So you don't know, ever since then, we'll be waiting for ICAN to even test APV, if not internal, if not MPV, give us APV. But ICAN has not looked in that direction. It has always been, since 2022 to date, it has always been May diet and November diet. Compulsory question has been business valuation. So that's for you to know how important is business valuation. Therefore, we don't know what is coming. Nobody can predict this is the area examiner will test. But one thing is certain that certainly you are going to have business valuation. If not as compulsory question, then it will be as either section B or C. So that's the only topic that's the most tested topic in ICAN exam. From the time since I know about ICAN, there is no doubt that examiner will not test business valuation. Okay, but we are not doing business valuation now. So I just want to show you. I think that's the last. Now, for those of you that have the golden book, you can see we have about 15 illustrations. 15. This is the question here. This is the question I'm looking for. We have about 15 illustrations in this material, which is more than sufficient for you to practice. Okay, so I want to check solution to requirement number B and C. So what you need to do, okay, solution to B and C. Now, this is it. This is solution to B here. B1. Asset beta, also known as on-gear beta, measures only systematic business risk. On the other hand, equity beta measures both systematic business and financial risk, and it is usually greater than the asset beta because it contains both business and financial risk. Since unsystematic risk can be diversified, okay, the focus generally is on the systematic risk, which is unavoidable. Then number B2, the company's required rate of return of 16%. We have calculated the cost of equity using capping. This is the cost of equity here. All right, this is the cost of equity here using capping, and we got approximately 16%. So I'm just trying to explain that the company's cost of equity, the company cost required rate of return is 16%. See calculation below, relative to the project internal rate of return of 20%. The project appears financially viable and should be undertaken. So we are trying to compare your calculated rate of return of 16% relative to the internal rate of return of 20%. You know, the decision rule on internal rate of return is that if your calculated IRR is greater than the company cost of capital, you said the project is financially viable. So that is the basis of this recommendation here. However, other factors may need to be considered before final decision is taken because our decision is based on capital asset pricing model. Capital asset pricing model has some criticisms, so which make it not which make it very susceptible. Not all the investors rely so much on capital asset pricing model because most of the assumptions, the underlying assumptions of capital asset pricing model are not realistic. All right. However, this is the additional information I provided on that. The first one is project risk. Cost of capital should be consistent with the risk associated with a project. The company's equity beta of 1.2 indicate that the risk associated with the business is higher than that of the market, which is always 1. Now, under capital asset pricing model, for those of you that did financial management at skills level, you would have been taught that the beta of a market is always 1. If the beta of the project is higher than 1, it means that the project is more risky relative to the market. If the beta of the project is less than 1, it means that the project is less risky as compared to the market risk. So in the question, examiner has given us the company's equity beta of 1.2, which indicates that the risk associated with the company is higher than that of the market. However, it is important to know the beta of the project. We are not given the beta of the project. Our focus supposed to have been on the project, not the company. But since we are not given the beta of the project, then we cannot arrive at a reasonable conclusion whether the project is risky or less risky. All right, that's number 1 issue we have discussed under this. The second issue is on the appropriate cost of capital. Appropriate cost of capital is required to discount the expected future cash flow associated with a project for the purpose of determining its financial viability. So the rate of return of 16% is not the same as the company's overall WACC, except where the company is only financed with equity. though there is no indication in the question that suggests that the company has a debt in its capital structure, except for the bank loan arising from the method of financing the machinery. So if the company is financed with debt capital, the cost of equity will not be appropriate to evaluate the investment opportunity. In that case, what we need is the weighted average cost of capital, because we have calculated cost of equity using capping and we arrive at 16%. If the company has debt in its capital structure, that means this 16% will not be appropriate because you have to use WACC. You have to, your cost of capital must be consistent with the risk associated with the project. Okay, so that's another issue. Then the third one is the capping that we have calculated. Most of the underlying assumptions of capping, including the fact that all investments are indefinitely divisible, that is, you can invest the fractional part of the project. In this case, we have about 86 million naira as initial outlay. So what capping is saying is that fractional parts of the investment can be undertaken, which is not all the projects you can do that for. Not in all cases. Another assumption of capping is that of homogeneity of expectation of investor. That is, all investors have the same expectation in terms of return and the risk associated with the investment, which is not true because every investors have different kinds of risk appetites. All right, the risk tolerance of each investor are different from the other. Therefore, but assumption of capping is saying that investors have homogeneity expectation in relation to return and the risk, which is not realistic in any case. And also, one of the assumptions of capital asset pricing model is that there is no transaction cost and there's no taxes as well. These assumptions are not realistic. It is not possible. Once an investment or a project generates a return or profit, certainly such profit will be taxed. Not only that, the capping assumption is saying that there is no transaction cost. How is that possible? When you want to make an investment, you are going to relate with your portfolio manager. The portfolio manager will not do the service for you for free. You have to pay. You have to pay some service cost. And in that case, can you say there will be no transaction cost, which is not possible because the middlemen we also need to we want to earn a profit on the service rendered to you. So these are some of the reasons why the model has been subjected to criticism in practice in relation to pricing risky assets and determining cost of capital. So the most risky assets is stocks, that is shares, all right, because shares fluctuate, the price of shares fluctuates. Yeah. So these are the issues examiner wants you to comment on. These are some of the issues examiner wants you to comment on in the number B2 requirements. All right. Then number C of the question, which talk about the sensitivity analysis. I've already told you what you need to do on this one. You go to the question, you go and pick the tax liability as calculated before. You pick the tax liability. This is the tax liability that we have calculated in the table. All right. Then you adjust it with the tax saved because the essence of capital allowance is to reduce tax liability. So the tax saved that you have before that you have calculated also will less. So whatever you have thereafter will then be the tax liability after the capital allowance. So these other ones is what you are going to use to calculate the 17% given to discount with the 17% given. And we have the total present value of 20. When you had 0.9 plus 7 plus 6 plus 6, it will give you 20. So that means the present value of a tax liability is 20. You then divide it with the NPV. NPV as calculated, the net cash flow are all of these ones. All right. We discount it with 17% discount rate. We have NPV of 5. Therefore, sensitivity margin of tax liability is calculated as NPV over the present value of tax liability. And that is what we have here. And it gave us 25%. You need to interpret that result you need to interpret the 25%. What this 25% is saying is that tax liability should not be allowed to increase beyond 25%. If not, the project will not be viable. If you increase this, the tax rate is 35%. So the current tax rate is 35%. It means that for this project to remain viable, you can still increase that 35% tax rate by additional 25%. So anything above this 25%, it will make the project to become negative. The NPV will become negative, which will not be viable. So that's what sensitivity analysis measure, and this is what the examiner wants you to do. So that's that. That's end of the question. Let me know if you have any question for me so that we can close the class. So like I said, if you have the golden book, try as much as possible, ensure you cover all the examples you have in the question so that you can be well exposed. Particularly in your material, there's a question on the Washington PLC. Please go and try that question. Go and try that question, and then let me know the solution let me know your solution. If you don't have the golden book, but if you have the golden book, just go and check the answer in the golden book. It's there as well. The question is a little bit technical, and then you just find your way, solve it, and then let me know if you have any issue. Okay, then. Any question for me? I want to close the class so that I can release you. So in our next class, Laura is saying that we have not completed the cost of capital, that we have an outstanding scope. Then I will check, then I will get back to you. If you have outstanding scope, then that's the first thing we are going to do in our next class before we move to adjusted present value. So I need you to go and read adjusted present value. That will be the next area that we are going to touch, we are going to discuss. All right. So in the absence of no further question, some of you have disappeared, but alcohol is still on. Clement, Ether, Ijoma, Laura, Moses, Tosin, Sharafadin, Tayo. All right. It's okay. I understand. So I will see you guys next week by the grace of God, when we shall continue. We shall be doing adjusted present value. Thank you, everyone. Good night. Bye-bye. Okay.
Please help us drop the note, please. Thank you, sir.
No worries. You're welcome.